Okay. Now, hopefully you could hear me. This I know we talked about breaking everything down into a month's time frame, but I think just giving you a whole video explaining everything to the finite detail and having you just practice what I'm teaching you would work. Before we start off, I want to openly say that I would openly apologize now for whatever tapping you hear. This is a screen recording, so you're gonna hear me tap my phone a lot. If you could overlook that, then you will be able to obtain the knowledge in the proper way that you need to. I know we talked about going ahead and having you download TradingView. Hopefully you've done so. Let me open up my TradingView really quick. Oh, wait, is it? That is not TradingView. That is my Trade Locker. And I need to update. Ain't that crazy? Alright, so while that updates... Oh, that motherfucker. I've been trying to figure... Somebody changed our names on Discord. And we've been trying to find out who the fuck went ahead and did so. Hopefully you've been catching up on the chat. Join in on that conversation. If you have any questions, if you just want to fuck around, if you just want to go ahead and, just, have a good time, jump into the general after being verified, and you can have an open communication with everybody. You have to go ahead and here. So you have to hit this verify button right here. This check mark, you have to tap it. After you tap it, your account will go through a detailed verification, just to make sure you're not a bot, just to make sure you're not a spammer. After that, you'll be able to have the full access to the server. Go to general, and everybody is pretty much in here right now. Anyways, hopefully you have everything else downloaded and you have something to write down notes with. I right now am trying to look for water so that way I stay hydrated throughout this conversation. To keep this all short and sweet, I'm going to try to compress what would be a 3-hour video. I'm going to try to compress it down into an hour and 30. And there's no promises that that will happen, just because of the detailed information that I have to go through, the examples that I have to show you, and whatever have you afterwards. We're going to go over the 6 confluences. We're going to go over strategy. We're going to go over the game plan that you need in order to have a strategy, meaning a trading plan. The define why to have a trading plan is because you don't want to go into the market blindly. You want to have a plan of action before stepping foot in it. So, to give you an example of what a good trading plan would look like, is mine personally would be, I don't trade any other session but New York. The time that I trade is 8:30. The time that I stop trading or stop looking for a trade is anywhere from, say, 1:30 to 2 o'clock. If I can't find a trade, or if I'm not in a trade within that time frame, I don't take it. I don't. I add risk management into that as well. I don't bet more than $100 for a trade. If I do go over that $100 limit, two things have happened. One, I am overconfident, and overconfident the trade is going to play out in my favor, and everything plays out perfectly. Two, I am having an abundance of confidence for all the wrong reasons, and my trade fails me. It would be the only two reasons to why I over put more money on the table. But nonetheless, I walk into a trade knowing I'm willing to lose $50 to $100. Anything in that middle range between 50 to 100, fair game. I am only looking to take two trades within a single day. Again, if I go over that limit, I have fucked up. Why do I only take two trades? Put it simply, simplicity is key. If you start adding in different variables, if you start doing extra shit, you start gambling and risking more capital than you are willing to lose. That, within a nutshell, is my trading plan. You yourself are going to have to come up with your own trading plan that fits your schedule, that fits your whats, that fits your whys, that suits you. That is one part of your homework that you need to establish. You need to go ahead and break down everything that I just went through. You need to have and I hope you could write this down. You need to have a session that you want to go into. And at first, it's okay to meddle, it's okay to dibble dabble, it's okay to test. After you've done your testing, you want to be able to have a finite session that you feel comfortable with, i.e., schedule fits perfectly, and that you are more comfortable with looking at. The next way of forming your plan again is to figure out how much money you're willing to go ahead and risk on a daily basis. After that, you need to go ahead and determine how many trades you are looking to take within your day. What else? I feel like I'm missing something. Oh well, we're not going to sit here and just think about it. We're going to keep this short and we're going to keep this shit sweet. So, after you have your trading plan done and settled, what I need you to go ahead and get situated with is getting used to looking at TradingView. The two indexes that I and everybody else that does this strategy will go ahead and use are the NASDAQ or the S&P 500. This strategy could go ahead and work with any kind of pair or just a single index alone. But this strategy works well with futures pairs alone. If you're looking to go ahead and get into Forex trading, such as like currency pairs, soy, bean, chicken, shit like that, then the strategy isn't going to work for you. You might as well go ahead and stop looking at this video now and go find out what would work for your Forex future. After you go ahead and download TradingView, what I need you to go ahead and do is look up the two indexes that I just explained. You're going to add a symbol. You're going to look. You're going to type in NQ. It will be the first one that pops up. It doesn't matter which one you choose. The data will look pretty much the same all across the board. What really matters is that you have these two indexes. We can look up ES. ES is the mini micro contract version of S&P 500. To put that simply, it is the cheaper version of the S&P 500. The full the other side of the coin beyond besides minis would be just normal base S&P 500 and normal base NQ. We cannot look to enter into those indexes just solely because the entries are just too fucking much. Just for NASDAQ alone, or actually, let's go to ES. For ES, you need about $6,000, over $6,000 to place a trade. Like that's ES. Now, NQ on the other hand, you need $25,000, just a little bit over $25,000 to place a trade with NQ. We use the mini micro versions because it's a cheaper way to get into a contract, get into a trade and place it. So after you go ahead and have those two situated, you're going to go ahead and open it up. You're going to trade. You're going to go into paper trading. Your account is going to look different. You can go ahead and place whatever account size balance you want to start with, and try to work your way up off from there. It will look just like this, but with different numbers. To get to the actual chart itself, there's going to be, there's going to be this little box right next to all. You're going to click that. Your version is going to look 10 times different than what my version is going to look like. Only because I have set up my chart to look the way it does. When you open up your chart, you're going to see blue candle or green candles and red candles, and you're going to see a white background. If you would like to learn how to edit your canvas, let me know and I can make another video about that, and you could just change it upon however you could change it however you like. To get situated and used to what you're looking at right now, to walk you through, teal candles are green candles, purple candles are red candles. All right, so teals are sellers or buyers, purples are sellers. What we're going to start off with is explaining what the confluences are. What are confluences? What is trading? I should have started off with that. And we're going to move down the list of everything, and then at the end of everything, I'm going to show you how to build the strategy, and then how to execute it in multiple different ways. I'm going to show you what is a good way to enter and what is a bad way to enter. What you should be looking out for and what you should not be worried about. So, what is trading? What is day trading at its core? Some people will argue this with me left and right. I've had people in Discord just go full blown fucking nuts over this question, and that is day trading gambling at its core? I say that it is. I truly believe day trading at its core is nothing more than just gambling. I use this example to back up my theory. When a good poker player goes and sits at a table and places a bet down, do you think he is placing that bet down because he is not confident in his results? Or do you think he is placing that big of a size of a bet down because he is completely confident in his result? I believe it could be the latter. But a good poker player is going to go ahead and put his money down on the fucking table just simply because he knows the probability weighs more in his favor for whatever reason there might be. Another way to explain it is like this. People that count cards and go make a living off of that at casinos make a killing because their strategy works. It is not foolproof. There's going to be times where they either get caught or they fail, or their strategy fails them. But at the end of the day, these people completely have an understanding that they're working with probability. As traders, we need to have the exact same mindset because, again, trading is gambling at its core. We need to go ahead and understand that we're working off of probability. One is that. The second is we need to have a good edge that shows consistently good results. Because if you have a bad edge, if you say you have a good edge but it doesn't show classic results time and time again, is it really a good strategy? Like, if you're losing 50% of the time and winning 30% of the time, and it's not a psychological problem, it is a strategy problem, you yourself would 100% say this strategy doesn't work. What I'm about to present to you is a strategy that holds just about a 50% probability and plays out quite well. But first, you need to understand the basic steps to get to that point. In the video, or in the log that I sent to you, you can see that there are only 6 confluences, 6 rules that we have to abide by. I'm going to go down the list of each one: liquidity sweep, break of structure, equilibrium, fair value gaps, inverse fair value gaps, and last but surely not fucking least, 79 extension on the Fibonacci. Those are the 6 rules that I abide by, and many other traders that follow this concept abide by. They won't necessarily trade in the exact same way. Like, I won't. The only reason why that is because we're all different people. We all have different processes of breaking shit down when it comes to thinking about things. Not every trader is going to trade the exact same way. Just because they're following the exact same rules doesn't mean your outcome is going to be the exact same outcome of somebody else's, i.e., you playing out your concepts the same way. It's not going to happen. I just needed to stress that. So, with those 6 confluences: liquidity sweep, break of structure, inverse fair value gap, SMT, and 79 extension, we need to go ahead and figure out exactly what they are and how to find them. We're going to start off with liquidity sweeps, and then we're just going to go down the ladder. Liquidity is, you might be wanting to write this down. Liquidity is nothing but resting buy orders, sell orders, or limit orders waiting to be tagged. It can hold to the upside, and it holds all the way to the downside. That's why we see higher highs and lower lows in the market. There's nothing but liquidity, resting liquidity here, 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 and here, waiting to be tagged out. What happens when liquidity goes and gets tagged out? Well, you can see that right here we have, that's not a really good one because that's not technically a liquidity sweep. Right here. So we have a high right here. Liquidity swept this prior high. What did it go ahead and do? Tumbles. When we see a liquidity sweep, it is fair to say that there is a good possibility that the trend is looking to change direction. Again, I would point it out. Here's the prior high. Here's the other candle that took out that high. I'm sorry, that's a bad way to explain it. Here's the prior liquidity. Here's this liquidity's candle that took out the prior liquidity. What happened after that liquidity sweep? We see a shitter straight to the downside. We see a positive change in direction. That's not the only way to go ahead and define a change in direction. The next way to go ahead and define a change in direction is a break of structure. A liquidity sweep will most times have the wick pass above a prior high. Most the other times you'll have like a full blown body get pushed above the high, but most of the time you'll see the candle's wick get pushed above it. But with a break of structure, it is the exact same way. We see this high right here, we see this full bodies candle get pushed above this prior high, creating the break of structure, which then gave us the confirmation that the trend is looking to change direction. And it was a positive change in direction just based on how all these other candles printed. Cool? Cool. So, to just reiterate what's happening here, I'm going to go ahead and break down the trading strategies rules first, and then I'm going to go ahead and give you candlestick structures afterwards. All right, continuing. Break of structure, inverse fair value gap. No, we're going to go over fair value gap before we go over inverse fair value gap. That's where I fucked up with the last video. Fair value gaps are a 3 candlestick pattern that form in the market. It can be a red candle, red candle, red candle, as we see here. It could be green, red, green. It could be green, green, green. It doesn't matter what color it appears as. What truly matters is the way that everything forms. Let me show you. So when we're looking for a fair value gap, we need to see the middle candle. We need to see the first candle's wick short enough, like so. Boom. Once we define that, we go to the third candle and we look for the exact same thing. Cool. After that, go back up to the first candle, mark it out, drag it down, drag your tool down, and right there is shown a fair value gap. Damn it, I don't know why that was so hard to say. What is a fair value gap? In essence, it's just an imbalance in the market that is needing to be rebalanced. This void right here needs to be filled. When is it going to be filled? God only knows. It could be filled within this time frame right here. It could take somewhere. It could take anywhere. Like it could play out over here. Point being is fair value gaps need to go ahead and get filled. Just to give you a clear example, here is, I can see another fair value gap. Right here to right here. What did price want to do? Come in, balance out that price, break structure, sweep liquidity to just go higher. All right. What I want you to do for your first side of homework is write this down. The first homework assignment is to find 10 fair value gaps. Find 10 fair value gaps in the market, draw them out, get comfortable with seeing them, get comfortable with using them, because you're going to be using them a lot. This is a good time to transition over into a inverse fair value gap. Now, for a fair value gap, we are again looking for price to go through and possibly have a reaction off of it. Well, for a inverse fair value gap, it's the opposite. We are not looking for price to treat this as a floor. We're not looking for price to use this imbalance as a floor to go higher. We're looking for price to use this imbalance to just break through. That is what a inverse fair value gap is. It could be to the up, it could be to the downside, it could be to the upside. Either way, we need to see price wanting to break through that resistance. The resistance being this imbalance right here. Cool? If you don't, if that doesn't make sense to you, ask me about it at a later time, or go into a YouTube video and look up what is a fair value gap. Now, SMT, an SMT divergence is when one index makes one high where the other index makes a lower high. So, just to give you a good example, let's see if that was a positive SMT. Not really. Okay. We have an SMT right here. This index did not want to break through this low that I had just marked out, where ES gave little fucks with, wait, did I even mark out the right candle? Yeah, I did. Okay, so it's not this blue candle down here. Let me delete this really quick. I've already went ahead and apparently marked it out. This red candle, this red line right here is the prior low. We can see that ES did not want to go past this low until the next session, where, oh, fuck. So let me explain that again. NQ refused to go ahead and break through this session low that it created, where ES hold on, let me go ahead and clean my glasses real talk. Let me clean my fucking glasses. This is some fucking bullshit. So in essence, What is a SMT divergence? It's when one index refuses to make a higher high or break through a low or a high, where the other index just doesn't really give a fuck about it. You see how big this? I'm trying to find a good SMT divergence. The only way that we could find an SMT divergence is on a higher time frame, or on a 5 or 10, 15-minute time frame. But we didn't have an SMT divergence on the 1 hour. What about the 15? Okay. You see how this is the SMT divergence. This candle's wick refused to break below this low that was created in a prior session. We go to ES and we see right here that this wick gave 2 fucks about what the other index did and blew through it. Go back and show you. Here's the low. Here's that same candle that refused to blow through. It did go ahead, the wick did go ahead and push through it, but the body refused. Where here, there is no long wick, but the body of the candle itself passed through it. To define what is an SMT divergence is when one index makes a higher high where the other index makes a lower high, or a lower low and a higher low. It depends on how your bias is going to play out for the day. Cool? Cool. If you have any questions about what is an SMT divergence and we want to get into it a little bit more, I'm more than happy to go ahead and show you in another video. Again, I'm trying to compress this shit down into an hour and 30, and I have an hour left to break everything further. Moving on up. What is the 79 extension? Well, it's just a Fibonacci tool that I use to find the last leg in the trend to give me a trade. So say if I was late to the party here, but I wanted to catch this last move here, I'd go into the 1 minute. Hang on. Discord is just fucking going crazy right now. If I wanted to find the last leg up, well, let me just make sure I have this shit right. Okay. Yeah. All right. So if say I missed all this right here and I got in, I was starting to look for a trade right here, started to see my confluences play out just a little bit, and say I wanted to get my entry in. Not my entry. I wanted to look for an entry. I'm going to use this. I'm going to mark out the last swing low. Put it all the way up to the last swing high. Nope, sorry, marked that out wrong. Went from the high, get down to the low. And why aren't you letting me scroll down? That's weird. All right, so that looking for the trade entry over here just wasn't going to be it. I'm waiting for the 79 extension to get hit, and we see that it was hit with these candlesticks right here, but normally you don't want to take a trade off of, you don't want to buy high, you want to buy low, so you want to wait on the red candlestick to form. And then normally, like, this may not play out, but what you want to do is wait for the 79 extension, come in, sorry, I haven't used TradingView in a minute. I've been using other platforms. Put it there, look to the right, see what else we could go ahead and target. Anything else is right here, so what I would like to do is target the last low. And we can see within that very same time frame, the trade plays out. That is a way to take and use a Fibonacci. We want a candlestick to hit the 79 extension, and in this case, we're in a bearish trend going down. I'm looking for price to hit this, sell once the 79 extension gets hit, to then put in my trade for it to just win me it within the next 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 minutes. It only took me 11 minutes to win that trade. That right there is what a scalper would do. But I try not to use the extension that much unless I'm late to the party and need to find a last minute entry in. That's the only time that I would use the extension. Or if, say, we were all the way up here. Say we were all the way up here and there was nothing else over here to go off of, like there is. Like there's nothing over here to go off of. There's this high down here, but that was already blown through. We can't use that. See, nothing else for us to use as liquidity. So what we will do is use the Fibonacci tool to look for take profit. Sorry, wrong entry. Take it from the last swing low all the way up to the last swing high. Oop, I marked it out wrong. Last swing high all the way down. Put it there, and then, so do you want to go the opposite way? Let me explain that. So when you're looking for take profit levels with the Fibonacci retracement tool, target this last swing high and just pull up, and it's gonna, instead of pulling down, you're gonna pull up. Wait to see where the 79 extension is, and you could just possibly wait for your trade to hit out then. But in this case, it didn't do so, so therefore it wouldn't have worked. Again, we work off of probability. There's times where it does happen, there's times that it doesn't happen. You just got to count your losses where they are. But most of the time, that's how you would find take profit levels. Me personally, I wouldn't use it in that fashion, just because of how you just see it not play out. Yeah, there's a lot of times where it does that. I don't like that kind of probability. I don't like that kind of result. So I only use the Fibonacci retracement tool to find where price has the likelihood of going back into, or using it to find the last ditch entry for my trade that I have missed. Coolio, cool. Go back into the hour. Awesome. Now we go into EQ. Equilibrium is a fancy way of saying it's just a fancy way of saying price in the market, a discount in the market. So sorry. It's just saying that like when you go to a grocery store, you look to see what kind of prices are higher or lower. You normally would want to go with the price that's lower because it benefits your capital. Same way with this, you want to go ahead and buy low, sell high. A good way to do that is by having an equilibrium to figure out where there is a discount in the market. So to determine where you are placing the retracement tool, you need to first establish what is your trend. Are you in a bullish trend? Are you going up? Are you in a bearish trend going down? Say in this instance, we're in a bearish trend. You're going to go ahead and use the most recent high down to the most recent low. So we're going to go, let me draw that back out. Go to the most recent high to the most recent low. Sorry, I probably should have drawn that out a little better for you. So we go here. Can I get it right? Let me see if I can get it right. Right in the line. Boom. Down to the most recent low. And with this candlestick right here, we can see that that touch in would have been a discount in price. We don't go enter into a trade just because we see a discount in the price. There's other rules that we need to abide by well before even thinking about placing the trade. But that is one way to look for a discount in price. There's other ways of doing it, but that is the most simplest way that I do it. That's pretty much it. That is pretty much what the confluences are. Now, let's go over, what did I say, candlesticks? I don't like to use fancy head and shoulders, mountaintop peaks, shit like that. I don't fucking believe in that. What I believe and what holds true are just simplistic candlestick pattern charts, such as what I've talked about before. Fair value gaps are a candlestick pattern chart, simplistic candlestick pattern chart that is easy to follow by. Highs and lows, we're about to get into that next, but that is itself a candlestick pattern chart. Those two are the only patterns that I would pretty much abide by. So we're going to go ahead and talk about what is a low and what's a high, how to find them. A high and a low consist of two candlesticks, a green and a red. How do you determine what is the highest point of those two candlesticks? Well, you're going to go ahead and use the candle's wicks. Actually, no, let me explain what candles are. Candlesticks are what they exactly sound like. They're just big ass fucking wicks and bodies to the downside. Big bodies in either color will tell you that whatever color it presents itself in that time frame is stronger in that moment. right? So we see here, we see buyers are stronger, but we see sellers are just stronger. God, and they held price to go down. When you're looking at a candlestick, you're always going to have wicks. You're going to have wicks to the upside, or you're going to have wicks to the downside. These play an important part in our strategy because, like I said before, candle wicks blowing through a last high will go ahead and give you a shift in direction. Here's the last high. We can see that this wick blew right through it. What happened? Capitulate. Straight to the shitter. Straight to the downside. And that happens, this happens on every single time frame, on any given day, every second of the day. Like, this shit happens. So the wicks play a very important role in this, such as the bodies. Without the bodies of the candles, we cannot really determine if there is a break of structure to be had. What is a break of structure? Again, it is a confirmation that price is looking to change direction. We have the liquidity sweep first, we have the break of structure next, and with those two things playing out simultaneously, we are being told by the market, hey, there's a positive change in direction. You need to be ready for it. The market, when that happens simultaneously, you're being told, get on your fucking shit. Lock the fuck in. Because price will either move violently, or it might take time to move in the opposite direction. But the point being is, it's looking to move in the opposite direction. So, just to simply put, what are candlesticks? It's just a green candle and a red candle. You have wicks to the upside and to the downside, and you either have small bodies, you have big bodies. Now, you also have candles that look like this. What we call these are doji candles. These are my favorite. Why is doji candles my favorite? To put it simply, it's because it means there is a indecision. There's a decision to be had in the market, and the market's looking to make that decision very soon. We see here an indecision. The market is deciding whether or not to keep buyers prevalent in the market. We see that they tried. We get a small candle, we get a bigger candle, and then we get a huge candle. But out of nowhere, the sellers said, pipe the fuck down, buyers. Pipe the fuck down. We run this shit. Let me show you how we run this shit. Boom. But just a gigantic ass fucking red candle to smack the buyers in the face. The buyers try to get back up after that bitch slap, but couldn't hold itself, and now this is where it sits, on the fucking floor, where the sellers are just looking down on it, saying, what the fuck you're gonna do next with this doji candle? We're gonna find out on Sunday if buyers can get back up and smack the sellers back in the face. Meaning there's going to be a liquidity sweep to the downside to have price go back up. Possibly. I'm not saying that to be true, but that might happen. It might not even happen because we just had a break of structure to the downside. The break of structure happened here. This is the last low that happened on a higher time frame. This right here is the candle's wick that blew through it, so the sellers might actually still be prevalent. We have another break of structure down here. I'm getting ahead of myself, and I'm just fucking wandering off. So how do we find the highs? How do we find the lows? Well, we use the highest point of these two wicks candles. So with this green candle, red candle, we use the highest point of these two candlesticks to find the high. which is right here. Boom. The next homework assignment that I would like you to go ahead and do is find 10 highs and 10 lows. Actually, no, fuck that. I want you to find 20 highs and 20 lows. Why do I want to make it so much? Because I want you to get used to seeing it. I want you to get used to marking it up. I want you to get as fast as I am when it comes to marking this shit out. Like I can easily just run through this without a second glance and give you a shit ton of highs to play off of. Oof, that was a beautiful one. That just screamed at me like a fucking banshee. Look at him. Let him cook. Let him cook. Let him cook. Let him cook. You know what I mean? I want you to be as fast as that. I want you to be as fast as that. Now I'm going to give you examples to the downside. I'm going to get rid of all this extra shit. And now, are you always going to have your chart looking that messy? No. You're not. It's going to look more simplistic. It's going to look more organized. But in the beginning aspects, it's not. I need you to start getting comfortable with marking shit out, seeing the chaotic mess that it is, and never going back to that chaotic mess again, because the structure that I'm about to give you makes much more sense than that bullshit. Cool? Cool. Now that we know where the high is, we now have to find the low. It is the exact same candlestick pattern, two-stick candle pattern, but the opposite is, the difference is, we're looking for a red candlestick and a green candlestick this time. We're then using the lowest point of those two candlesticks, wicks, to determine what is the low. All right, so again, what is the low? How do you find it? You look for a red candlestick and you look for a green candlestick. You look for the lowest part of those two said candlesticks, which in this case would have been that one. All right, tell me where you see in this area right here. I want you to tell me where you see another low. If you said right here, you're fucking right. You're fucking right. Good job, Beaner. Boom. That is your low. All right? All right? I want you to go through, and just like the highs, I want you to find the lows. Get comfortable with finding the lows and marking them all out. Do this 20 times until you get comfortable with seeing highs and lows. Like, I'm rubbing my eyes right now without my glasses on, and I was still able to mark that bitch out. I'm not saying that this is going to be easy at first, because it might not be, but when you get used to this practice, it becomes simple. It becomes very easy. Cool? Cool. That's how we find highs, and that's how we find lows in the market. What's next? We can go into fuck. Let me get my notes out. I wrote notes down for this situation. That way I didn't forget about it. Yeah, we'll go through trends next. What is a downtrend? What is an uptrend? Well, a downtrend and uptrend is exactly what it sounds like. An uptrend is when price is looking to go up. Downtrend is when price is looking to go further down. How do we determine when a trend is near its end? Well, when we see a liquidity sweep happen or a break of structure happen, but most times on a higher time frame, you're looking for the liquidity sweep to happen on the upside or the downside to see the trend finish. You're looking. That's just simply put. Uh, for discipline, I would say the best way to build discipline is to cut out all the negative and bad behavior and bad habits that you have obtained along the way, and try to maintain a steady head a and having reliable and maintainable goals that you can achieve throughout this time. Because if you don't have anything tangible to go off of, and if you don't see any kind of like simple results, it is very easy to get discouraged, and it's very easy to just want to get the fuck out. So, with having simple goals set up, with having the discipline to back up those goals, you will be able to go ahead and thrive. You can say, I have the motivation to do this, I have the motivation to do that, but at the end of the day, motivation ain't shit if you don't have discipline to back it up. Simply put, there's going to be a lot of days where don't feel like waking the fuck up and getting on the chart, marking out your shit 30 minutes or waking up an hour ahead of time, marking out your shit just to be ready for 8:30 to come around. There's going to be a lot of times when that shit happens. And it's going to be very easy to back up that reasoning when you're failing your trades over and over and over again. The discipline of knowing that this shit works gives you that confidence and helps the motivation even more, hand in hand. The best way to build a discipline is to maintain a healthy and reachable routine and goals that can push you towards the direction you need to go ahead and obtain your goals, if that makes sense at all. Now, moving on to the whole explanation of the strategy itself, we're going to go ahead and do this. Now we're getting into the fun shit. Alright. What are we looking for? One, and write all this shit down, please. One, we're looking for a liquidity sweep on the 4 hour, on the 1 hour, 4 hour, in the daily time frame. Oh, and prior session highs and lows. Trying to make sure I could get this. Okay. 2, we're going ahead and waiting for a 5-minute confirmation. Confluence. That's coming in the form of a break of structure, inverse fair value gap, IF. Am I really doing that? IVG, SMT, and a 79 extension on the Fibonacci. All right. 3. I'm looking for a 5-minute continuation to the downside or upside. That's coming in the form of an equilibrium or a fair value gap. 4. After we find and see the continuation, we're looking for a entry. We do that in the 1 minute time frame. So 1 minute confirmation. That's continuation. New confirmation, you motherfucker. Really? Whatever. We're just gonna leave it at that. We know what it's supposed to be. And then this comes in the form of a break of structure, inverse for value gap, and the 79 extension. All right, write that shit down. Oh, I forgot a few steps. 5, enter the trade. 6, we're targeting prior. Really? We're targeting prior draws of liquidity, on liquidity. In our direction. Write that all down. Your best bet is to pause this video, write that shit down. Cool? Because we're moving on. Awesome sauce. All right. So now I'm going to go into my Forex trading. Not my Forex, my FX trading. This is, again, where I go ahead and do my back testing on. Now I'm going to show you how we can go ahead and use these confluences to take this trade. This is the trade that I had sent you a couple of days ago. I haven't back tested just because, well, I've been trying to make the video all day and it turned out to be shit. So I had to remake it in a smaller time frame. Anyways, so we're going to act as if this is not here. We're going to act as if this is not here. We're going to act as if this is not here. And we're going to do this, 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 and that's it. Cool? Cool. So, now, what I'm doing is, what I left out was daily bias. I will make you another video on how to form a daily bias, but the reason why I left that out was to not get you ahead of yourself. Because the information I'm giving you now, yeah, you can just go ahead, learn this shit, and enter the trade. But if you don't have daily bias, you're not going to be successful. You're not. And the reason why I'm not giving that to you just of yet is because you're not ready for that. You're not even ready to even think about taking the trade. The only reason why I'm giving this information now is because, to be honest, I think it'd be easier for you to watch an hour's worth or maybe 2 hours worth of a video instead of dedicating a whole month to this. Yes, it would show me you are more capable and invested if you were to play it out for the whole month with me, but life happens, situations come about, and it's sometimes hard for you to show up all the time. So with giving you a video that explains majority of everything, it's easier for you to understand. You're able to go back into it. You're able to either go back in your notes, go back in the video, and rewatch everything. I know what kind of daily bias I have, so I'm not going to break that down just because it's going to give you an insight on how to find daily bias. So all I can say is I know that I'm bearish. I know I'm bearish with a small retracement to the upside. With that being said and done, I'm looking on both of these indexes to see which one is going to give me the liquidity, which one is going to give me the SMT. Remember what I said about the SMT divergence? One index makes a lower low, where the other index makes a lower low, or sorry, one index makes a higher low, where the other index will make a lower low. In this case, the higher low was the S&P 500, and the lower low was the NASDAQ. This also tells me which index is stronger to take the trade off of. I'll also explain that. No, fuck it. I'll explain that now. The reason why we look for the SMT divergence is because we are able to go ahead and determine which index is stronger to take our trade. Because like I just said, one index is going to, just simply put, one index is always going to lag behind the other index, where the other index isn't going to lag behind and just skyrocket, right? We want to take the index that skyrockets. We want to take the index that is not going to lag. The best way that I can explain this to any newcomer is this. The pairs that we use are like brothers. Not every brother in a family is going to be stronger than the other every single day. They're both not going to be stronger at the same time every single day, right? So in this case, we want to take the trade, we want to use the stronger brother to take the trade, where we want to leave the younger brother behind. Another way to look at it is like this. One brother is going to go ahead and tell the future for what the other brother is going to do. That's another way to look at it. So we could see that this index wanted to push down and did, and we can see that it made a higher high here, where this index didn't push down all the way below, but seeing as that other index made a higher high at that time and this one was lagging, it showed us where market wanted to go. In this case, market wanted to go up, but the stronger index is going to show what happens next for the weaker index. It's always going to happen. In this case, it was the NASDAQ that held to be the leading index in this trade. Again, how do I know that? Because the NASDAQ was able to push below this low, where the S&P 500 didn't even bother to come down to this low. It stayed above. So that's one good indicator for me to take the trade on the NASDAQ. I'm not waiting in the hourly time frame for a high, 1 hour high, session high, or 4 hour low to get hit. Same way with the upside. I'm not waiting on the hourly time frame because price looks different on any time frame that you jump down. If, for example, we were just on the 1 minute or the 1 hour, we can see that the data for price was compressed into just 2 candlesticks, where if we get into the 15-minute candle chart, we can see that data is now like separated and easier for us to see and break down. We could see more we could see more candlesticks being printed instead of just those 2 candlesticks. We could see the red candlestick printed here, where we couldn't see that on a 1 hour. So it looks different price looks different on every single time frame that you go into, and it's even more so when you go down into the time frames, or go lower into the time frames. it's fun to go lower into the time frames and find all that data, but the rule of thumb for this is higher time frames hold higher power. It doesn't matter what the 5 minute is going to do, it matters what the 15 minute, 30 minute, 1 hour, or the 4 hour, hell, even the day, week, and month do on their own. What holds true to us when we take our trades, though, ultimately is going to be the 1 hour, the 15 minute, the 1 hour, 4 hour. We just, not to go deep into daily bias, but that's in a nutshell how we work with our time frames. Moving on, we are now waiting in the 15-minute time frame. We can see hold on, let me make sure I got this right. Yeah, we can see that liquidity went ahead and swept. Did it break through the low first? I'm sorry. Hold on. I read that wrong. Wow. Okay. So liquidity swept the downside. It broke through prior session lows. At this time, after the break of structure, after the liquidity sweep, I'm in the 5 minute, and now I'm looking for my confluences to go ahead and tag through. What am I looking first? I'm looking for a break of structure, of inverse fair value gap, SMT by divergence, or the 79 extension. Well, we have already determined that the SMT divergence happened on a higher time frame with this index blowing through this low where the S&P 500 did not. Cool. One of those confluences for the confirmation for the trend shifting direction has happened. Awesome. The next thing that we're trying to look for is another confirmation on the 5 minute. We're looking for a break of structure or the inverse fair value gap. Here, we do not see any fair value gaps to be had on this side. So we are not using that confluence. The other confluence that we could rely on is a break of structure, which is a very good confluence to go off of. Why? Because it is market is telling us that there is going to be a positive change in direction. Remember what I said in the beginning. My daily bias was that we were bullish or bearish going down with a retracement to the upside. Retracement being prices looking to go higher than it was going prior. With that information being said and done, I'm looking for a bullish trade today. So, anyways, looking for a break of structure. This is the last high that was, so, okay, let me break it down. Liquidity sweep. Did we have a break of structure with this? Nope. Because the high wasn't formed here. Did we got a break of structure here? Yep. That's a positive break of structure if I ever did see it. Cool. After the break of structure, we go ahead and drop down to number 3 of the rule set, which is 5-minute continuation. We're looking for that in a form of equilibrium or fair value gap. Now, yet again, we come back over to the left. We look to see, is there a fair value gap to be had? Is there an imbalance in the market to be had? Nope. So the other confluence that we could go off of is the equilibrium. So get my tool out. I have to find where the true break of structure was, which was here. This candlestick. I'm looking at the prior high, dragging it down to the low. Oop, I'm sorry, I'm looking for a uptrend, not a downtrend candle. So right here is the last low, dragging it up to the last high. Awesome sauce. And what do you see? I see that same candle wick right here touched in. So now, after that, I'm jumping into the 1 minute and looking for a entry finally. Looking for that in a form of a break of structure, fair value gap, or I'm sorry, a break of structure, inverse fair value gap, or a 79 extension. We're not going to use the 79 extension because we're not late to the party, so that's out of the picture. What we're looking for next, break of structure, or an inverse fair value gap. Same rules applied. We are looking to see if we have a inverse fair value gap over here. Nope. I could have sworn I entered off of the inverse. I did. We see the inverse fair value gap all the way up here. So after I seen the Fibonacci or the Gann box get touched in, I'm instantly looking over here to my right to find the inverse fair value gap. I forgot to leave out that inverse fair value gaps are also used for a positive change in direction. You're going to look for either a inverse fair value gap or a fair value gap well before you see a break of structure, or you're going to look for a break of structure before you see a fair value gap. You want one of those two situations to happen in order to tell you that there's going to be a positive change in direction. Cool. So now we're waiting. We're seeing price do its thing. Now, like I said before, we can enter off of the break of structure. Where do we have that? We don't necessarily have to wait for this whole gigantic move that we had. I don't even think there was a break of structure. Here's the high, we couldn't blow through it. We had, yeah, we had to wait. We had to wait on this closure. So we get this closure in. I'm not buying in the green candle because, again, we buy low, sell high. So I'm waiting on a red candle to form to then look to enter into the trade. I get that entry with this candlestick right here. We could say that I entered in right before the candlestick blew out of it. My low is now all the way down here. I'm looking to the right. And I'm looking at prior highs to be taken. I can target here, I can target here, I can target here, I can target here, or I could target all the way up here. Now, you don't want to shoot for the stars. What I mean by that is you don't want to place your trade all the way up here all the time. You don't have to take the whole move. You do not have to take the whole move. We're going to pretend like this never happened. Me personally, I would have put it all the way up here. That right there is a good risk to reward. Not really. So, cool. Now we're looking to go all the way up here. Still not a good risk to reward. Ah, I see where I fucked up. My stop loss is a little bit too far away. But I don't think I have a good entry point. Am I in the one? Oh, I am. Okay, so just to get a better entry, just to get a better risk to reward, you would usually want to mark out all your highs, but you're not always looking to trade the full move. But in this case, I would have to look to trade that whole move just because the risk to reward is not there. All right. So, say I want to target this. Does that make sense? Yes, that gives me a 1.27 return on what I need. And if we drag out, we can see that the trade would have taken some time to play out, but it ultimately did. And it kept going. Like you see where my levels are. This is another take profit right here. Take profit. And it ripped through every single take profit level. In this case, shooting for the stars would have worked out, but you don't always want to do that. To show you that this strategy works, I'm going to go back. In order to be profitable, or to be considered profitable, you need just about a 30% win rate in the market. Me, with the strategy that I use, I have a 57% win rate in the market. I have taken 7 trades. 4 trades I believe I've won, 3 trades I've lost. This is the breakdown of the strategy itself. Best win was 6%. Worst loss is only 1%. And my average loss is just almost 1.5. My average win rate is almost 3. So my average consecutive losses is a little bit more than it is for wins, but that's only because I had to break even or had to cut my losses a little bit shorter than that. You go down, you could see that I stick to my trading rules. I do nothing but trade in New York session. I don't give a shit about anything else. My highest win was almost $400, just placed with 2 trades. I think my lowest was $39 with 1 trade, and that's a trade. That $39 is happening only because I needed to cut my losses short because I overextended, tried to reach for the stars, and didn't achieve what I needed. And my lowest loss was just about $100. Lost it, just either didn't play out the strategy that well, or just didn't have the right psychology in that time frame. We can see when my best wins are. Wednesday, Thursday weren't really all that optimal, but Monday and Fridays are usually the days that are prevalent for me. I usually only like to trade just about 2 to 3 times a week. Well, that's what I'm trying to get into. If you trade less, you're ultimately going to survive a little bit longer. Where if you're trading a little bit more often than not, you're going to lose more capital. Now, for a beginner trader, you need to consistently practice the strategy that I've displayed to you over and over and over and over again until you get comfortable with it. The proof that I'm showing you with this is to give you confidence to show that it works. Okay? This is all that I'm trying to show you. I'm trying to show you that what I'm doing works. And it's not fugazi, it's not. If you were to lose a trade, it's not because of the strategy, it's because of you. If I lose a trade, it's because of me. I did something wrong. I fucked up somewhere along the lines. Okay? So, with all that said and done, you can go ahead and one day hopefully have payouts that equal up or even more so to what I have right here. Like, this is an even month so far, but my wins are so much more than my losses are. And that's because I've just gotten